Resurgent India Knowledge Series presents live webinar on Reserve Bank of India Project Finance Directions 2025. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers Mr. Gulshan Malik, former Deputy Managing Director, State Bank of India. Ms. Priya Kumar, Executive Director, Power Finance Corporation. Mr. Samuel Joseph Jebraj, DMD, NABFID. Ms. Bhavani Ghatamneni, Chief Finance Manager, F&A, Gujarat Urja Vikas Nigam Limited. Mr. Subrat Das, Chief Financial Officer, Greenco Group.
Yeah, good morning, friends. I'm Ashish Agrawal from Resurgent India Limited. I would like to welcome all of you in this today's webinar on a very, very important topic, the financing world. It's on the RBI directions on the project finance. And we have very experienced, vast experience panel speakers with us from the various backgrounds. So from banking, then DFI, then corporate, and the government PSU also. So we would like to discuss, I would like to welcome all the panel speakers here for confirming for this webinar. This shows their commitments towards the project finance. And all the speakers are having very, very vast experience on the project finance side. So it will help us to understand what they think and what are the impacts of the circular on the various stakeholders, whether say banks or NBFCs or financial institutions or corporates and the public at large. So this will ease the project financing, or this will make it tough, or what will be the direction for the future also. So friends, I would like to once again welcome to all of you, and we will request you to please make it more interactive. So we have all the panel speakers, they will be happy to take questions also. So whatever the questions are there which are relevant to the topic, I will request please ask these questions in the chat session or in the Q&A session, so that we can cover up the topic in a better manner, so that everybody should be aware that the directions of the RBI, what will be the advantage and disadvantage to all of us. So this is my request to all of you. Please cover up, please write in the chat box for your questions as much as possible. So first of all, I would like to welcome to Gulshan Malik ji. He is the former Deputy Managing Director of the State Bank of India, sir. Sir, welcome to you, sir.
Thank you.
And,
Thank you.
Yeah. Then we have Madam Priya Kumar. She is Executive Director, Power Finance Corporation. Good morning, ma'am, and welcome to you.
Good morning. Thank you.
Then we have Sri Samuel Joseph ji, DMD of NABFID. Sir, welcome you and good morning, sir.
Good morning. Good morning, Agrawal ji.
Thank you, sir. Then we have Subrat Das, sir, who is the CFO of Greenco Group. Sir, good morning, Subrat sir, and morning.
Thank you, Mr. Asif.
Thank you, sir. We have Bhavani ma'am. Bhavani ma'am, she is Chief Finance Manager, F&A, Gujarat Urja Vikas Nigam Limited. Welcome, madam, and good morning, ma'am. Yeah, so friends, we have a small PPT which will try to just cover up the whatever the areas are covered in the circular in a proper form, so that it can help you to understand what are the areas which are being covered in the circular by RBI, so that it can help us to understand and to discuss in a better manner. Yeah, next slide. So friends, this circular was issued on June 19, 2025. So, and the effective date of this circular, or I will say that the project financing new guidelines will be from 1st October 2025. Next slide. Yeah, next slide, please. So the key objectives of the circular is to basically standardize the project financing regulations for all banks and NBFC and other financial institutions. So they have covered almost all the lending institutions in this circular, and they want to RBI want to give that direction on the risk management also, so that there can be a standardized risk management process also, and the stress resolution, it can enhance the early recognition of the risk or stress, and this can be resolved faster also. So practically the key objectives are these three areas are there, which are very, very important, and it will help to centralize the entire project financing process, the banking system, or the entire lender community also. The next slide. So it covers every, I think, every institutions which are into lending space, and if you see that only the projects which are having the financial closure before October 1, 2025, they will not be covered under these directions as of today. So we have almost 3 months from now, where the project which is having the financial closure before that, these provisioning norms and other guidelines will not be applicable. Next slide. So RBI has tried to give the detailed definition on the various aspects of the project finance. So they have covered both greenfield and brownfield projects under that project finance. So if somebody is setting up the new project and he not having any experience of that project, then it will be covered. If somebody is having already some industry and they want to expand it, then it is also covered. So the good part is that they have covered both the things, and they have covered that it was already there that 51% of the loan repayment should come from the project cash flows. So this is the definition of the project finance actually. And then they have covered that when the 90% of the project funding or the entire debt equity and the other any grant also which is required in the project, when it is committed, then the financial closure will be called as a financial completed. The financial closure has been closed. So this is a very, very important area which we need to keep in mind. The next slide. So this date of commercial operations or commencement of the commercial operations, they have given the complete detail about that actually, and we see that it was there earlier also, but now they have clarified. And this date of commencement of commercial operations, they have permitted that there can be extension of that also in certain conditions, where for infra project it can be for 3 years, for non-infra it can be for 2 years actually. And if this can be extended also without asset downgrade, if the project cost rises by 25% more or more due to increased scope of size. So we will discuss on that, what will be the impact of it actually. Next. So the RBI has covered that land should be tied up in advance, so that there should not be any challenge once the project has started or the money has started disbursing. So they have given 3 areas where the for the PPP project, which are infra project, they have given this minimum 50% land should be tied up, and then for other project it is 75%. And transmission line, for transmission line project, there is no condition or there is no requirement. It depends on the project appraisal and all these things, that what should be the minimum land which should be tied up in advance. Yeah, next slide. So this is something regarding the sanction. So they said that they have given some uniformity to all the lenders, that original DCCO should be clearly documented, but which is very, very important to define in advance. And another thing is that this 85% of the project, this repayment schedule should not be more than 85% of the project economic life cycle, actually, economic life of the project. So this might impact the top-up loans and all. We'll discuss on that also. And minimum lender exposure this is another area which they have defined. Earlier it was, I think, there to some extent in the advisory form. Now it is the part of direction. Or so they have said that up to 1,000 crore, 1,500 crore of the project, minimum exposure by one lender should be 10%, which we'll discuss in the detail. And the approvals and clearances should be there before financial closure. So all approvals, clearances, but they have given some relaxation also in case some approvals which are not possible to get before financial closure. These approvals can be taken later on, but they have, this should be decided by the lenders and the other stakeholders in advance, that which are the approvals which will be required later on or which cannot be taken up in advance. Next. So the implication, if you see to the lender, I think this is better that there will be higher compliance for them, but there can be some increase in the cost, but this increasing provisioning and all can boil down to the lower financial risk. And there is a standardized guidelines also, so it will be across all the lenders. So from our point of view, it will be, I think, positive to the lenders from the project finance point of view. Next slide. From the borrower's point of view, the corporates which are into infra, RE or non-RE, they are, I think, for time being, there will be some tighter disbursement rules, or there will be some areas where they have to be very, very particular, so that the financial closure should not be delayed. And the one thing which was there, that moratorium period, I think in the earlier draft circular, they have given some 6-month moratorium maximum. Now they have given the flexibility to the banks also. So from the borrower point of view, it is positive, but only thing is that the borrowers or the corporates should have the all these things in place in advance, so that there should not be any hiccups during the construction phase of the project. Next slide. Yeah, next slide, please. So in impact point of view to the different sector, I think infrastructure, there may be some detailed delay in the financial closure, but it is better that once the financial closure is done with the new guidelines, they will not be further delayed. Then the real estate also, so they have given some strict norms for them, but ultimately it will be beneficial. For the smaller institution, which are maybe small corporates also or smaller bank, this might be little difficult because they are the stricter guidelines which they have to follow for the compliance point of view. Yeah, next. Next slide. So RBI, we have just tried to give the comparison. I think it is almost covered. I'll just run through it very fast. So in the draft circular, which was issued in the month of May, and the new circular, which is issued in the month of June, what are the difference? I think if you see the provisioning side, there is a big relaxation which they have given. Earlier, they have thought of 5%, which is now 1%, 1.25%, which will be, I think, helpful from the banking point of view, of the lender point of view. And then the other areas are there, which are regarding this additional provisioning for delays and all. There was no specific provisioning figure was given or percentage was given. Now they have defined the specific percentage also. So this is another area which is important. Next. The next slide, please. So applicability, and I told that it is applied to the both new and existing projects, and we see DCCO extension and all. I think now it is very, very much clarified. Earlier it was 4 years, but now it is 3 years. So there will be some, I think, changes in the overall working. Moratorium period, it was earlier it was a cap of 6 months. Now it is not there. Next slide. The next slide, please. This is something which we have tried to cook from the RBI data that as per the RBI report, there was something 9 lakh crore of the project cost funding or project costs which were funded by the financial institutions and banks in last 10 quarters. And we see the 70% of that is the financing which they have taken. So 6.5 lakh crore something amount which is funded. So this is just a calculation which we have tried that what will be the impact if we take the old data and then try to figure out. There will not be much of the impact on the provisioning side. So roughly 2,000 crore of additional provisioning may be required, that too in 2027. Because in 2026, it's only for 4 months or 5 months. So for the banks and financial institutions, there will not be much of the impact on the overall profitability due to the additional provisioning which the RBI required in the new guidelines. The next slide. Yeah. These are 3-4 areas which we thought as Resurgent India that RBI should reconsider or should try to give some relaxation. So MSMEs are the backbone for the country, and they are coming out with the project. And so we have just suggested that if possible, and the up to 100 crore of the project loans, this should not be, there should be some relaxation in these guidelines. There can be some differential guidelines which must be more friendlier, more, I think, easily possible to meet out. Then AIF is one of the newer area where a lot of AIFs are there in the country, and they are to debt funding also. And real estate, if you see that the real estate, many AIFs are there which are funding the projects, and maybe in the other area they may also start funding. So practically they are not covered in this in the direction. How the RBI can cover these AIF, it will help also because then it will be a level playing field for everybody. Then minimum exposure guidelines, which is up to 1,500 crore of exposure in a project. The minimum 10% exposure should be by one bank. So our suggestion is that there are many such banks which are not very large, but they are having the capability to take the exposure, or they invest in project finance also. So this might impact their exposure in these projects. They might not be in a position to take any exposure. So like small finance banks, which are now growing also, and the RBI relaxed currently that this priority sector funding should be 60% or rate by 75%. So they will be keen to take some exposure in the larger projects also. So this might be possible. They will not be in a position to take exposure, but the RBI can cover up maybe 10% will be reduced to 5% because over 1,500 of crore of project, they have covered only 5%. So this might help also. Then green financing, this climate, one of the very concern area, and ESG is also coming up with very fast in the entire ecosystem. So if the green projects or green financing can have some relaxation in these areas, maybe in the provisioning norms and all, where I think they can boost up the funding for these projects actually. So this is something which we have just thought of that we should run it and just try to understand from the RBI point of view and what are the concern areas of the industry and all. And these are the actions from the lender. So compliance, they have to invest a lot of money on the compliance side. They have to strengthen the compliance. Borrowers, approvals and all might be a challenging thing, but they will get the approval in advance, then it will be better. And from the overall point of view, this will help to have a healthier financial system, ecosystem in the country for the growth of the country and for the growth of the banking system also. So this is overall from our side, and thank you so much for this presentation. So friends, now I will invite our guest speakers, and we have Gulshan Malik ji, who is the former Deputy Managing Director of SBI. So, Gulshan sir, first of all, again, thank you to you and welcome to you also, sir. Sir, we'd like to understand because I think you have lived with the project finance in entire your career actually, and I think nobody can be better than you who understand project finance with a larger institution, the country. So, we'd like to have your views on the circular from the different aspects point of view. So, over to you, sir.
Thank you, Ashish, and all other participants of this webinar. This RBI came with their initial guidelines on the prudential guidelines in June 2019. By that, actually, they have actually repealed a lot of their earlier policies and the CDR, S4, and all others. But at the time when they came with that they actually decided that they will not come for the DCCO guidelines at a later stage because they just wanted to have the views of the developers and all other lenders, financial institutions before actually going for the guidelines. But actually, when they came with the draft guidelines, these were very stringent. And the reason which they have given for giving this stringent condition was that project financing is slightly riskier than the other corporate financing. And many of the actually institutions were writing the large checks without understanding the risks. So because of that, because RBI has seen it in the last cycle, which was between 2004 and 9, when a lot of funding was done. And maybe that was the first stage when the banks were learning and most of the projects were coming. But after that, between 2010 and 2018-19, we could found that a lot of the projects could not go through the proper their life cycles and they struck. So because of that, they understood the risk and they tried to come with the stringent guidelines. But after that, then there's a lot of discussion happened between the developers, lenders, and the RBI. And I will give credit to the RBI. RBI took all the whatever the suggestions given by lenders on whatever the steps they have taken to mitigate the risk regarding the project finance, they have taken into account. And when they came with these final guidelines in June 25, these are many way relaxed than whatever the guidelines given in the draft. And I will just mention 3-4 that they have said it that the initial provisioning will be 5% during operations and then 2.5 as you have indicated. They have given the moratorium will be 6 months. So like this, the 100% land should be acquired, 100% financial closure. So they came with this because of their experience. But when the lenders could convince them on the various steps which they are taking, and because of that, RBI, when came with the final guidelines, they have relaxed some of the conditions. But what the RBI has done, while they have relaxed on certain conditions like this, that they have said provisioning will be 1% only under implementation and 0.5 after the completion, and even the moratorium, they have left it the discretion because each sector, each industry have their own operational issues. And because of that, they have not given this one particular guidelines for the moratorium. But what they have done it, they have given various guidelines. So whatever the mitigation banks have actually told the RBI that they are making, they have ensured that these are included in these guidelines. So what happens when all these conditions are stipulated as a part of RBI guidelines? Are these developers and the RBI is the lenders have no option but to comply with that. And how they have done it, they have ensured it whenever any financial closure is happened and in case there is any change in the DCCO, then they have ensured is that you have to do a TV. So that this is something the RBI guidelines which each bank have to comply. Earlier, sometimes what used to happen, the developer used to negotiate with the different lenders that in case you will do this, then I will come to you. Otherwise, it takes a lot of time with you. So I will go to some other bank who will not ask for these issues. And because of that, some of the negotiation bank used to relax some of the conditions. But now when these conditions and the guidelines have come as a part of RBI guidelines, I think there is no room for the developer to negotiate in that. That is actually bring the sanity in the project financing. And what they have indicated, in case you do an appraisal and after that there is any change in the appointed date, then you have to again do the assessment of this and take approval from this, so that in case there is any change in this overall viability, the same is taken care of. Similarly, whenever any SCOD is to be changed, they have ensured that after the SCOD change and any cost over funding is there, you have to go for a rating from the ECR, external rating, even when there was no rating from for the original one. So, and that rating is to be the investment grade. So they have given various steps that you have to take it to ensure that whatever project financing is done, that is done as per the guidelines, and there is no room for the anybody to relax on that. I think these are very important, and they have also said when this project implementation is there should be a LI or the architect who will basically monitor this project implementation. So these are the guidelines, because earlier what was happening many times because of the negotiation and the discussion between the banker used to relax some of the conditions. So I think RBI has done a good job by ensuring putting up these guidelines as a part of their direction. So that will, I think, bring sanity in the overall project financing, and ultimately it will be in the long run good for the banks, developers, and for the country for doing the project financing. This is my view on this.
Great, sir. Thank you so much. As a senior banker, your views are very well, and you have rightly said that long run this will be beneficial to all the stakeholders.
Yes.
We have PD. PFC in any way, or the way you are doing the project funding, will it change or it will remain same also? Over to you.
Yeah, good afternoon, everyone. Basically, as Mr. Gulshan Malik sir also mentioned, that these guidelines, these directions have brought in more clarity in the regulatory treatment. So it's not that we were not doing anything earlier, but now that these directions are there, at least it creates a common platform for all the lenders to follow these directions. Now, because of this, now what will happen is that this will give a greater confidence to all the lenders while funding to infrastructure projects. And the directions focus on bringing about more credit discipline and improved risk management, and also enhanced credit quality. But they also provide flexibility to the lenders to exercise, their judgment within the defined boundaries. So, like while sanction, it is allowing the lender to decide on which clearances are applicable. Okay, and at what point of time, which are the milestones at which the clearances have to be seen. These things have to be seen by the lender. And then again, while disbursement and there are certain milestones which have to be specified on the basis of which the disbursements will happen. So then there are other things specified, like extension, DCC or deferment. When the asset will remain standard, or if it goes beyond like 3 years, then there is additional provisioning. And so basically the guidelines are encouraging the long gestation projects funding, but they're also recognizing the inherent risks in the project financing, and they're giving a framework to address them. So you can do funding up to 85% of the economic life, so you can give long tenor loans. Then there is flexibility in the moratorium period, as has been mentioned earlier, that you can decide based on the cash flows of the project, or if there is a seasonal variation or whatever, then you can decide on the moratorium period for the projects accordingly. And then there is also facility for standby credit, in case, which you can sanction at the beginning, for any unforeseen cost overruns that can happen subsequently. Then there's cost overrun funding provision has also been given. Then additional funding on due to any change in scope and all has also been specified. So while funding cost overrun, there is also guidance on the risk pricing that you have to do. So that you have to specify upfront in the document. And a lot of credit events have been specified for early detection of stress in the project. So basically a structure has been created which will facilitate the funding in a better manner, and also create a common platform for lenders. So it doesn't happen that one lender is stipulating some condition, the other is not. And like even for land related conditions or other things, we already, as a lender, PSC stipulate certain PDCs, and or each lender has their own stipulations. But now at least they will all be brought on a common platform, so that there is not much variation in the conditionality requirements by each lender. So and the that flexibility is there, like Mr. Gulshan Malik also mentioned, that it is sector agnostic. So they have not tried to stipulate everything that for these projects this is there, or so basically promoting infra financing, and there is a lot of increased confidence in that part. But also they are also cautioning, nudging us to exercise caution while lending, because there are higher provision requirements in certain scenarios. So that will basically lenders have to be more cautious, and but things have been defined, and that is a positive.
Thank you so much. I think you have very well covered your deliberation. So now we have Samuel sir. Samuel sir, welcome to you again. Sir, you are a developmental financial institution country, and you are the newest or the startup in the lending system actually. So your views are very, very important. What do you think this circular will help to the developmental financial institutions, or which are the areas where you think that some positives are there, some negatives are there? Over to you, sir.
Yeah, thank you, Agarwalji, and good afternoon.
Yeah,
I think most of the points have already been covered by Malikji and Ms. Priya. First of all, we see this as a hugely positive one to the ecosystem itself. Compared to the draft guidelines and the final guidelines, this is definitely a big relief to all the lenders. The first benefit, what we see, is harmonization. I think both my previous panelists touched upon this. Otherwise, there was a race to the bottom in diluting governance. So now all the lenders will be on the same place with regard to what is financial closure, what are the approvals required. Even without achieving financial closure, first disbursements were happening. Only for subsequent disbursements, in some cases, financial closure was stipulated. So all that will come on the same platform. So harmonization across all, though you mentioned AIFs are yet to be brought in. On the infra side, AIFs are not a very large player. On the real estate side, maybe, but not on the infra side. So this harmonization is a very big benefit. Secondly, on provisioning also, I think this is very, very reasonable, what RBI has come. See, the main risk in infra financing comes only the implementation risk. And I think it is very, very reasonable of the regulator to expect that we carry a higher provisioning in our books. And 1% when the project doesn't get delayed or is getting completed as per the originally estimated DCCO is very, very fair. And if there is anything, earlier the blanket 5% was too stringent. Now, if there is a stress in that project, we make a specific provision on that account, 0.375 or 1.5% per annum is also quite a very reasonable. So on the provisioning side, both from a risk point of view and from lenders' point of view, it is quite reasonable. Cost also shouldn't go up too much from the developer's point of view. In our estimate, it is about 20-25 bps increase during the implementation period, and it should come back to normal after the 0.4% standard asset provisioning kicks in. Now, where we are a little, where I'm personally a little uncomfortable is if you look at, let's say, credit events. There are 5 events defined there. One of that is if DCCO is to be extended, then that becomes a credit event. Today also in many of our projects, for instance, if you take renewable energy projects, there is a 3-month or a 6-month extension because the evacuation pipeline is not ready and there is no point in commissioning a project or incurring the full capital expenditure when the other authority who had committed at the time of our sanction, the other authority says evacuation infra will be ready by so and so time, and accordingly we have arrived at the DCCO date. If there is a 3-month delay, then this also will trigger a 3-month delay in DCCO. But now what it entails is this triggers a resolution plan, because this has been brought as a credit event and covered under the prudential guidelines. So immediately 30 days ICA signing, then resolution plan implementation. Earlier, what we were doing in the normal course for a 3-month, 6-month extension now has to go through the prudential guidelines norms. So this is a little unwanted complication. Maybe it puts a little stress on the system, where even a small delay on account of that brings in a resolution plan. Otherwise, I think more or less everything is positive. A lot of ambiguity has been removed, clear definitions on what are the terminologies to be used. I think very positive to the entire ecosystem in our view.
Great, sir. Thank you so much, sir. And very thankful to you for giving very straight, I think, answers about 2-3 things which you have considered. That there can be some increase in the cost during the construction period, and the delay, small delay, the DCCO might have some stringent requirement for the lender. So this might, not because of the fault of the borrower, but maybe other party not ready. You are getting stuck in the project actually. So I think these things should be considered. You're right. Hopefully the RBI will also try to consider these things, reconsider these things. So thank you, sir. Thank you very much. So I'm really sorry. I think there was some connectivity issue. I hope that my voice is coming.
Yeah,
Yeah,
it is coming now.
yes, it's coming here.
So Subrata sir, sorry. Sir, you are representing corporate, the entire industry here actually. So we would like to understand from you, and everybody is waiting for listening you, that what do you think as a corporate, that what will be the impact on your entire process, or the funding costs, or the timelines and other things. So over to you, sir.
Thank you, Mr. Assis, and thank you all the eminent speakers. In fact, most of the things have been covered by all of them. I don't know what to speak now, but just let me take you back to 1991 when India decided to privatize the power sector. At that point of time, the fast track projects came into place. So when the TPS and the financial closure was to be achieved, there were lots of things which were there. You should have all the contracts in place. You should have all the clearances in place. You should have a state escrow account, your LC escrow, state government guarantee, counter guarantee from central government. All these things were there. So what this led to? Most of the projects did not come, and then the projects which came, one of them was Enron. Enron was the one which was having an ironclad PPA, ironclad contracts, and we know what the result was there. Or what was the result? What was the result of it? Then what happened? The projects did not come. India started reeling under the power crisis, and this went on for years. Then again in 2004, 2005, when most of the conditions were relaxed, power projects came in a very bang. It came the bang in a very big way. But in 2012-13, I don't want to throw the numbers. Most of the NPAs which happened with the banks, it mostly came from the power sector, and I believe many banks decided will not fund the power sectors. So of course, so also there has to be a balance between how much of strictness you want to put and how much of flexibility you want to give, so that the nation has to grow, and it has and otherwise we shall be reeling under crisis. Now coming to this guidelines of RBI, I think I take it this way: it's a welcome change, something to be welcome, because it brings discipline to the system. The compliance and other things which is imposing is really going to make the system in a very good way. And the best thing which I have liked is the disbursements will be linked to certain conditions. The disbursement schedule has to be mentioned in loan documents. Earlier, I believe there were some power projects were there. So 1,000 crores of disbursement have been made by some lenders, and no work has been done in the site. I don't know where the money was spent. So now this has to be documented before, and then only the disbursement will come. And that is the one which is going to bring the best discipline. Now coming to DCCO, now they are saying that DCCO has been reduced to 3 years. What is going to happen? It will be NPA and all. I also think that is a very good thing. A project which has been delayed for more than 3 years, is the intention is very different. I see the intention and interpretation. The interpretation of the contracts may be anything, but what is the intention of the promoter or the intention of lenders? So here, if a project has not achieved operation in 3 years, the delays for more than 3 years, I have the intention is something different, is what I see. So I think that what they say is that they from 2 + 2 to 3 years which they have put. I think that is very good. Now coming to the other part of provisioning, as a corporate, see the infrastructure project where the EBITDA is about 90% of the revenue. It's the financing cost which plays a very big role. And with this provisioning, of course, it's good for the bank to bring discipline, but how the lenders are going to look at it? If they are going to drastically increase the project cost, the 25 basis point which Mr. Gulshan Malik said, is that also is going to have a big impact, because we are looking at interest cost. Our interest cost is still far higher as compared to what we get from other countries. You get loan, ECB loan, which is very cheap, but what is killing us is the hedging cost, which is very high. So when we are looking at optimum cost of financing, when we look how to reduce the cost of financing, this is going to create an impact. How the lenders are going to view it, and if they drastically increase the rate, the project automatically will become unviable. Especially the most of the delays which are happening is, of course, the developers are responsible, but most of the delays are because this Mr. Samuel pointed out, is because the clearances and the other government approvals are getting delayed. And if you wait for all the clearances and other things to happen and then start the project, you are just going to be a disaster in the country. So if the extension or delays are happening because of this, as a result of which you are going to penalize the corporate, you are really creating a disaster, because the interest cost will go up, and interest cost plays a very big role as far as the renewable or infrastructure project is concerned. Lastly, on the 15% of a tail which you have given, I think there's something else could have been also done. Why give 15% tail? Because why not give it extend it for the 95% or even 100%? If you see the project is doing well, if you see the debt is being furnished well, if you see the DSCR of the project is high, why restrict it to 15% of tail? Why not increase the tenor? Or why not allow? So if you can go for refinancing, and which can go up to the end of the project life, that will be beneficial, because a developer will show interest only when he sees that he's making some money out of the risk which he's taking. Suppose, why should I invest in an infrastructure project where there's so much of risk, where I get 14, 12 to 13%? I put it in the mutual funds, I get more than that. So why will the person take all the risk? So at least some interest of the developer has also to be addressed, and that is possible when these things are taken care of. So this is my view, and I think I don't want to repeat what others have said, because they have given the bright ideas and with the experience. From the developer point of view, I think I've given my views. Thank you.
Thank you, Subrata sir. Thank you so much. I think thanks for your straightforward reply or answers of various aspects. Actually, the interest cost, disbursement schedule in the sanction letter, or maybe tail, why it is 15%. It can be, I think, left to the developer and the lender, because his commercial decision is also impacted because of this. So good, I think, good point. You have given good food for thought for the RBI, and RBI might think of considering these things. So friends, now we have Ms. Bhavani, and she is Chief Financial Manager of GUVNL. So, ma'am, welcome to you again. So, we would like to understand from you, you are representing the state government, PSU, and you are having the lot of developers who are basically engaged with you in various projects. So, what do you think as a state government organization, what will be the impact on the projects which we have already been given to the various developers in various segments? And what is your thought process about this circular? And do you want any relaxation from the RBI on this side? Over to you.
Thank you, Ashish ji. Good afternoon to all of you. Ashish ji, I congratulate you for this knowledge series initiative. And from government point of view, what is affecting us the project delays, which is not coming on time, the DCCO time, which are being extended due to the land acquisition and all. These guidelines, stringent norms, which is already being followed by, like Priya ma'am said, the banks and NBFCs, the regulated entities are all following. They have their own policies and all. Okay. But this gave a common platform for all the regulated entities, the common approach. Okay. This is a structured approach for a stress resolution mainly. And the definition of the credit event, which I remember Samuel sir also mentioned that a DCCO extension by the evacuation line is not available for 2-3 months, fast charging problems. Due to that, it should not become a credit event. Okay, that is our main concern. It should not become a stressed asset. Because of that, it should be classified as standard only, even in that case also. And most of the earlier speakers already covered all the points regarding these guidelines. I would like to mention these, the projects which are completed the financial closure already. I think they're exempted from these guidelines. They will continue to be with the previous thing. Okay. So these stringent guidelines will some banks and some NBFCs, they were asking for 100% land acquisition before the sanctioning, some banks, and before disbursement. And here it is clearly specified 50% for infra and 75% for other thing. Okay, that is the minimum requirement, which they were some of them were already doing it. Okay. So there might be some relaxation on that point. They might be giving who are following already 100% this thing. That's it from my side, sir.
Thank you so much, ma'am. Thank you so much. I think you have taken these issues very well, actually. Delay in small time because of others. I think Samuel sir also covered. I think you were also asking this should not be impact on this will not be credit event actually. So it can be considered also. And land acquisition, I think now across the board it is same for everybody. So depend on the RBI has given that, but it's not that that it's a maximum. So maybe 75% land acquisition is required, but the lenders are not comfortable with the 75%. They can ask 100% also. So this is good actually. Some direction is there, but it is on the discretion of the lenders and the borrower that how they want to take it forward actually. So thank you for your deliberation. So, sir, we have some questions for you, sir. We'll be happy to take these questions. And then we have many questions in the Q&A session. If you see 24 questions are there. It is not possible to take all the questions, but we have prepared some questions which we will just ask from you. Some of the answers will be there of the questions which the audience has asked from us. So, Gulshan, sir, there are two things which we like to understand from you. This new framework, basically, there is a condition of minimum exposure by each lender. How do you see this this case, the consortium arrangement? How this will change, or will it be changed? Will there be any change also? And the provisioning, which is little higher from the earlier provisioning, will it impact on the project pricing or the interest cost and the other costs involved in the overall project funding? So these two things are there. One is the cost to the borrower, and the another is the how the consortium will look like that. Over to you, sir.
Actually, in this case, RBI, since the last 10 years or 15 years, whenever we were doing the project financing, RBI is of the view that only the very serious lenders who understand the project financing should enter into the project financing business. It helps in both ways, because in case the number of lenders is too large and they have lower understanding of the project or the project financing, whenever you go for any modification in the project, it becomes very difficult because the number of lenders are more, and then in case they don't have the understanding of the project financing, it becomes difficult for to understand the reason for modification in that. And whenever the number of lenders are more, it actually goes against it takes a more time during the financial tie-up also. And whenever the project is complete and in case for some reason is gone into stress, what we have faced during the last time when the resolution of stress asset being taken over, some of the small banks who took exposure in the project financing of maybe 100 crore and 150 crore, when during the stress, during the resolution, some hit was to be taken to the extent of 30-40%. They actually found it that the hit to be taken in one particular account is actually more than the entire profit for the entire financial year. So they found it very difficult. So from that point of view, I think RBI want only the banks who can put a more meaningful, I think their contribution in the project financing, they should enter into this business because it is not a normal corporate financing. From that point of view, I think this will restrict the number of lenders, maybe 10 to 15, or I think that is the number they are working, and I think that is right also. And regarding the increase in the pricing, yes, during this now implementation, the pricing will be, the provision will be higher, and with this, the overall pricing will be higher. But as others, Mr. Samuel has also did, during implementation, project finance have certain inherent risks, which are during the implementation. And for that, carrying an inherent risk in the book, I think banks are supposed to have the higher provisioning also. And it may result in the passing on the higher provisioning cost to the banks, to the developers by way of increase in the interest rate. But I think this will align the provisioning in line with the risk of assets in the book. So I think it will be the matching. Otherwise, what we are doing, we were having the risk in our books, but we are not carrying the provision to that extent. So I think from that point of view, increased provisioning during the implementation, yes, this will be a cost to the banks and to the developer, but this is in line with the higher risk which the lenders have to carry in their book. So I think from that point of view, it is prudent to have this.
Okay, sir. Thank you so much, sir. I think there will be some impact. Priya ma'am, like we were discussing the cost during construction period, and after that, I think PFC policy, we are seeing that on the website. You have already provision that during construction period there will be different ROI, and then after construction period there will be some relaxation. So I think it was already built up in PFC tariff for the lender, for the borrowers. And the one more thing which you can clarify also, and you see that this now 75% land availability should be there for non-infra project and all. Will it impact the greenfield project funding to some extent for a shorter period? Do you think, being you are the larger player in the project funding also?
Yeah, so basically, it will have a different impact depending on the kind of projects we are funding. So if we look at the major infrastructure projects, there majorly land would be available when we, start the disbursement. And the challenge that I see is mainly for the renewable projects and specifically the wind power projects, because there the land acquisition happens in batches, and there to have a 75% upfront land acquisition prior to disbursement would be a challenge. So maybe that carve out, like the carve out is there in the transmission project, maybe that can be considered. And otherwise, we are also generally, we have been stipulating condition for renewable also that 50% of the land needs to be acquired before we disburse, and then there is pro rata disbursements based on the amount of land which is being acquired. So that is already there in our system. And for other infra, I believe that most of the land is already there before we start the disbursement. So even for road projects like in HAM and all, 80% of the land would be available. So there may be not much of a challenge, but yes, for wind projects, I see a challenge.
And regarding this cost to different cost during the construction and after the construction. So already you have some tariff which is already been announced. Will there be change in that because now the higher provisioning is required? So you will revise these tariffs which are already there, or any discussion on that? If you can give us some idea.
Right now, we are also still, internal discussions are happening on how to go about it. But yes, we have already built in. See, RBI is also recognizing that under construction projects have a risk. So once the projects are completed, that risk is over. So similarly, we had captured that in our interest rate scenario also, that under construction projects have a higher interest rates, and once the projects are completed and there's satisfactory commercial operations, then there is a reduction in interest rate by 25 basis points. So that is already built in the system. So we'll see how, if there is anything additional which needs to be done on this front.
Thank you, ma'am. Thank you. Shimal sir, there are 2-3 things which you'd like to just understand from you. Refinancing, will it impact the refinancing, the new guidelines? We have seen in the past that I think NAFED has done a lot of refinancing also. And the innovative infrastructure models or innovative projects, which are new projects are coming. So the new guidelines, you need some additional, guidelines should be there for these projects. Yes, sir, over to you.
No, first on refinancing, I think this project finance guidelines from RBI talks only about the initial thing. See, in the operational phase, in fact, even to supplement what Mr. Malik was just saying, and your question on why restricted to 150 crore or 10%, all that, I think to a large extent it is required. Even under this scheme, 10 lenders can come in, and one lender can hold the entire group to ransom if they don't give approvals on time and all that. So I think 10 itself is a very large number theoretically. So restricting the numbers at the initial phase during implementation phase is quite a reasonable thing to do. But the project guidelines also says in the operational phase there is no restriction, which means you can downsell even to smaller lenders. There is no restriction of 10% or 150 crore, whatever, in the operational phase. So operational phase refinancing, there is no constraint as we understand from the guidelines. And also, see, at present, many of us do cash flow discounting. So the project finance slightly shifts to cash flow discounting for the balance tenure and all that, where some of the lenders have been a little liberal with tail periods. Now we'll have to see how to interpret that, because the project finance guideline says 15% tail period is a must. Whether that flows into the operational phase also, post COD, I think we need to see what is the regulator's view on that. That would put a little constraint, as you also covered in your presentation, on top-up loans. Because most of the developers avail top-ups after COD when cash flows stabilize. So we will have to see. Some of the practices, even today, let's say HAM projects, the industry practice has diluted to 3 half-yearly annuities is the tail, not 15%. So I think all that will have to change now. But overall impact on refinancing of projects shouldn't be much. This is our understanding.
Sorry, innovative projects which are coming in the battery storage, pump storage, hydrogen, many such newer areas are there. So there will be any impact on these projects because of these guidelines?
No, while these are new sectors, whether it is BESS or the other things what you mentioned, I think project finance per se, the contours will remain the same. So there is too much innovation at the project finance stage is not very. I think we should not venture into too much innovation at that stage. However, completed projects, I think we can take a call depending on the stability of the cash flows. For instance, if this is a transmission project, completed transmission projects and PGCIL annuities, then I think insisting on a 15% may not be the right thing. However, if it is a wind project, as Madam also mentioned, where P90s have not been achieved in the last 3-4 years that we have data, then being a little too aggressive. So there we can afford to do a little bit of innovation, or we can devise a bespoke solution depending on the underlying assets risk profile. At the time of project implementation, in the implementation phase, I think too much innovation is not advisable.
Okay, great, sir. Thank you, sir. Subradhar, sir, being from the corporate side, so these 2-3 things, provisioning norms, credit event, land acquisition. So, how will it impact the negotiation, the term sheet with the lenders as a corporate? So, what do you think? Will it take more time? The lenders will be more restricted to these things, and the projects which you are already in the process for funding will get the funding at the right time of financial closure. So, any view on that, sir?
Yeah, this is definitely going to make things difficult. For example, as Ms. Priya had also pointed out, especially land acquisition, the wind project, you cannot get all the land acquisition in one go, and you have to get it in various locations. You have to wait one by one, and so if you want to wait for all that to happen, and then the disbursement is going to come, it's definitely going to delay the projects and is going to hurt your earnings. Second, also in the pump storage project, which you have pointed out, in the pump storage project, a very tough project, in fact, I can say, where you create 2 reservoirs, one in the bottom and one at the top. And to get approvals is a very Herculean task. And if you want the CA approval, there comes to again, CA approval is required. And if you want to have all the CA approval, the forest land clearance, everything to happen, and then you start the project, then I don't think it will see the light at the end of the day. Because we know very well that if you know that some amount of flexibility is very much required there, and if you're hell-bent upon it, today we are negotiating a term sheet with SBI, and Mr. Malik was a part of it. So the conditions which they have put, it will be very difficult to achieve those conditions before the disbursement. I always say that yes, there should be proper discipline, but too much of strict conditions will unnecessarily delay the project and will hurt the investors as well as the lenders. So this is going to be definitely tougher, especially not for solar projects. I will say solar projects who can get the land in one go and go out, but for wind projects where you have to get land in patches, and for pump storage projects which we are doing, to get the approvals, that too much of approvals are required, and to get the approvals and then get a disbursement, the project which takes about 4 or 5 years or even more than that, this is definitely going to pinch a lot.
Great, sir. So, being a corporate CFO and having very vast experience, do you want to give any guidance to the CFOs or the project finance people in the industry, how they can design their project financing, or what should be the precaution they should take when they are approaching for the new project fund?
So when the best thing, which again I repeat what I said, the best thing which has happened is the disbursements will be linked to the certain milestones. So I think that is the best thing which has come in the RBI guidelines also, and this is what they have to look at. So disburse the project when you see that the project is moving in the proper intention to complete. So once it meets certain milestones, you can just go ahead with the project instead of waiting for all the clearance and everything to come into picture. And the second thing is the costing. I don't want to repeat the things which has already been mentioned. But the last thing is when you go for refinancing the project, if you cannot reduce if you get a better terms of financing, if someone goes for refinancing the project, you should not put lot of conditions into it, put too much of penalty into it will make the project viable. So lighter terms are to be there for refinancing the project, because if someone comes with a better terms and conditions after the project is commissioned, if you cannot reduce the rate and someone else is doing it, you cannot put so much of conditions to it that you can stop them from going ahead with it. So that is my only concern, and that is my only advice to the people, up to all the 3 eminent lenders who are there.
Okay, thank you, sir. Thank you so much. Vani ma'am, one question from you regarding the shorter concession period projects. How would the tail period limit affect project viability or financing structuring? mainly for small developers. So from the shorter tail, basically shorter concessional period projects are also there, 7, 10, 8 years of, and the small developers are also there. So will it affect their project viability or project financial structuring because of this? You are on mute, ma'am.
Now the guidelines mandated that including the moratorium period, it shall not exceed 85% of the economic life of the project. Okay. So what we have observed in our developers, whatever the projects we have started also, commissioned also, the door-to-door tenor, including moratorium period, for most of the projects for solar and wind, whose life period is 25 years, it is around 20 years. Okay. So now this 85%, I think it will shorten that period. Okay. The tail period will be just 3.75, whereas previously it was around 4.5 years for them. And for like you said, concessional period projects, we don't have much, sir. Now we have only the standalone battery storage projects, which are having a life period of 12 years, will come under this, okay, under concessional period. And these projects may get affected, okay. These 12 years projects, hardly they will have 1.8 years with tail period. Definitely for top-up loans, they will be having a problem. I think this for our long solar and wind projects, there won't be any problem, sir, actually. The mandatory tail period will reduce the leverage in carrying capacity, I feel like, and it may increase the equity requirement by 8 to 10% for realigning the loan tenor. Okay, that might be the case, and it will restrict obviously the top-up loan facility for all the projects, and especially shorter period projects like our BESS, it will affect, sir.
The project viability may go a little haywire because of
yes.
this.
Yeah. Maybe the developer has to infuse their own fund, okay, due to this 8 to 10%, I feel like it will be more, okay, during the life of the project.
Equity is always a constraint for the developers, you know.
Yes.
Everywhere
Yes.
this is.
Yeah.
So once the equity will require, more equity will be required for funding these projects, I think they will be a little slow on the greenfield projects financial closure or timing.
Yeah.
Without some other page also. But no issue. Thank you so much for covering that. So I think we have covered from the our panel speakers about their thought process. There are some concern areas also. We'll take some 2-3 questions from the audience also. We have seen that almost 36 questions have been asked by the different people. And so I think a lot of people are interested to know many things. So there is a question, some Monte Carlo, somebody has written, that on occurrence of any credit event in existing project after 1st October, whether this 3 years guidelines will, with provision, will replace to earlier guidelines of 2 years delay without additional provision. Whether this 3-year delay is over and above the provided construction timeline as per authority. So, sir, anybody can take this question. Basically, I want to say that any credit event in existing project after 1st October, whether 3-year guideline will be applicable or 2-year guideline will be applicable.
I think they have very well clearly made it that after this 1st October, only this guideline will be there, and the earlier guideline will continue in case there is no change. But in case any credit event will happen, then this revised guideline will be applicable. So I think maybe that only the revised guidelines of 3 years only will be applicable, and there will be, I think, the old guideline will not be applicable in case any credit event happens, which is mentioned there.
Okay, so then it will be treated a new project.
It's not a new project, but under the new guidelines only.
Under
So
the
what
new
they have,
guidelines.
what they have mentioned it in case the existing is continuing and there is no credit event, then it will continue under the old line guidelines. But in case the implementation is happening, financial closure is happening after 1st October, or any credit event is happening in the old one, then new guidelines will be applicable.
Got it. Any other views or anybody would like to contribute on that, sir? Madam?
I think it's very clear. The circular is very clear, as Mr. Malik was saying.
Okay, great, sir.
Yeah.
Then one more question is there, sir. We understand cost overrun up to 10% can be funded. So this should be a separate facility, SBCF. It should be charged at premium this cost overrun can be on account of escalations of material prices and delay. No scope change required. So I think they want to understand SBCF का क्या impact होगा, उससे cost बढ़ेगी हमारी. I think we just want to understand. So they could not understand the question clearly. But sir, would you like to cover up, sir, what they want to ask actually? Yes, sir.
Samuel, sir. Yeah. No, SBCF already envisaging or pre-sanctioning it's a good thing. So it's already available in case of any contingency cost overrun. But the other way to look at it from the lender's perspective is we have sponsor undertakings. So this, in a way, dilutes that sponsor undertaking for meeting cost overrun, if you look at it. But overall, from the project's point of view, leaving aside separating lender, developer, or the authority, I think overall, having a contingency limit in place upfront is a positive thing.
Okay.
And cost overrun, they are saying you can fund 10% on account of DCCO extension, and that risk premium has to be there on the additional funding. So in fact, PFC already has a policy wherever we have funded cost overrun that it will be at a higher interest rate. So they are trying to cover that part in the directions. Basically,
Okay.
whatever you are funding as cost overrun, that has to be at a premium to your base loan.
Just want to speak on this, ma'am, to Ms. Priya. See, the cost overrun, here I would like to say why the cost overrun has happened. If the cost overrun has happened because of some unforeseen circumstance or for delays on the government side, which has resulted in delay in the project, as such, there is a cost overrun which is going to hurt the economics of the project. Over and above that, if you charge a premium to that, is further going to make the project unviable. So my point is, the submission to here is, if the cost overrun is because of the negligence of the developer for not doing the work in a proper way, yes, I agree premium is justifiable. But if the cost overrun is because of unforeseen circumstances like government delays and other force majeure government delays, I believe you should be considerate not to charge a premium to that to save the project from its viability.
Yeah, but the guidelines also mention that your basic financial parameters need to be maintained, and your external credit rating also should remain unchanged, if any. So
that's what I'm trying to say.
To cover the viability part from that angle.
That's what I'm trying to say. Because of these delays and all, the viability of the project is challenged. And over and above that, if you are going to impose premium or further cost to it, is further going to worsen the project. So I'm not saying that you should not impose, but if it is because of some government delays or for some from the unforeseen circumstances, some consideration has to be taken by the lenders. My request not only to PFC, Mr. Samuel and Mr. Malik, the same thing I would like to appeal to you for this.
Yeah, I fully agree with you. You are saying because of the cost has increased, then the interest cost will additional. But as Mr. Samuel has said, I think when we look at a project, we should not look it from the lender's point of view or developer's point of view or the regulator point of view. We should look at whether the overall viability of the project has been affected because the cost overrun or not. I think maybe this is the view the RBI is taking. Maybe it is adversely affecting you, but in case we keep ourselves three stakeholders separately and look only at the project, whether the health of the project has deteriorated or is improved, I think the costing is because of what is the risk related to the project only.
Okay. Thank you, sir, for deliberating this issue. I think it is helpful for all of us. Sir, UCO Bank FCC Ahmedabad has asked one question. I think this is from Alex sir.
I need to drop off because, as I told you, Mr. Hassan,
we'll finish it within 2 minutes only, sir. This is the last question I'll take, so that we can close it fast. So, sir, this is regarding this DSF. Please inform if any project where DCCO has been extended to 31st December 2025. Then in this case, 1% is required to provide as per the circular, or this can be old this thing. So do you want to say that instead of this 1st October, I think this is 31st December, DCCO has been extended. In this case, 1% provision will be required, or maybe the old provision will be required. I think he's asking in the old project, which is existing loan. So I think they are facing the situation for existing loan. What they should do if the DCCO has been extended 3 months. Yes, sir.
Mr.
So
Malik,
no,
I think
yes, sir.
My view, I think
Yeah.
credit event has already happened. This guideline talks about
Yes.
credit event happening after 1st October. It is not DCCO getting extended beyond 1st October. So the old guideline should apply. This is my view.
I think whatever is the in case this is extension of COD and or the cost overrun, in case it is happening before the 1st October, I think the old guidelines will continue. But in case event will happen even in a operational project after this 1st October, I think the new guidelines will then come into force.
Okay, great. So, yes, sir. Anybody would like to comment on that also? Okay. So thank you so much, sir. Thank you for deliberating this issue in a detailed manner. And I hope that this will be helpful to all the stakeholders. So we have many people who have joined from different background, from banking or the industry or professionals also. And some people have joined from the outside India also, like DFI, like ADB, IFC, and all these people have also joined. They would like to understand because they are also doing project funding. So I hope that this deliberation will be helpful to all of us. And we could not take all the questions of the audience. We'll try to give the answers. We'll send to our panel speakers. If somebody want to comment on that, then we will send, because we have all email IDs also. And I would like to thank you once again to all the panel speakers for deliberating on this issue in a very straightforward manner. Actually, this is the beauty of this discussion. Everybody has given the views openly. And we will try to make some discussion paper for RBI, or not the discussion, I'll say some recommendation paper to RBI based on the discussion. And before that, we will circulate to our panel speakers for their comment if they want to change it, anything. And we'll request RBI to consider these things also later on, after maybe some period, for the benefit of the entire ecosystem, whether industry, banks, or other lenders. So I hope that this will be helpful. And thank you to everybody from the panel side or from the audience side also for making it more interactive and successful. I would like to thank the Resurgent India team also for organizing this and bringing us at one place to discuss on this such an important topic. Thank you once again. Thank you, everybody.
Thank you.
Thank you.
Thank you.
Yeah.
Thank you.
Thank you.
Thanks a lot. Thank you.